Disney reported earnings and a ton of interesting news, deals with the NFL, with WWE before the market opened on Wednesday. And I think this is really going to be part of their huge transformation into much more of a streaming company. It's very possible that in 2026, Disney is going to generate more revenue from streaming than Netflix does today. That may sound like a crazy statement, but this is already about a $24 billion business on an annualized basis. That's before ESPN goes over the top. That is now happening August 21st, $30 a month, and that includes Disney Plus and Hulu. That's going to be the bundle that I think is going to drive the business going forward. So let's dig into exactly what we found out today. My name is Travis Hoyam. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. Let's start with the stock price move. You can see shares are down about 3% today. I thought that was an interesting reaction because most of this news I thought was pretty positive for Disney long term. And the biggest thing that came out is the deal to acquire the NFL Network and other media assets from the NFL in exchange for 10% of ESPN. Now, Disney is giving up some equity. They own about 80% of ESPN right now, so that number will go down to closer to 70%. But the win here is that ESPN is going over the top on August 21st. That's going to be priced at $30, and they're going to have arguably the best content in sports. They're going to go from 22 games shown on ESPN to now 28 are going to be available. That includes the games that used to be on the NFL Network. They're also going to be able to distribute Red Zone. We don't know exactly what that looks like, but it sounds like as early as the end of August, you're going to be able to sign up for Red Zone through the ESPN app, and they're going to be incorporating fantasy sports. So ESPN Fantasy Sports, ESPN Bet, and then also the NFL's fantasy business is going to be folded into this as well. That was part of this agreement. So ESPN essentially wants to be the sports hub for people streaming sports. I think this is a pretty compelling deal, especially if you're a cord cutter. I haven't had cable for over 10 years. And this is going to give me access to a bunch of sports that I didn't previously have access to. So I think this is a great deal for ESPN because the NFL is about 98 of the top 100 shows in any given year. That is a massive amount of power. That's going to give them the ability to draw in more customers, so customer acquisition, and also help prevent churn. If you're a sports fan, you're not going to want to cancel ESPN if they're attracting more and more of this content or buying more and more of this content. Speaking of content, there was another deal announced today, this morning, to extend NFL draft rights and also other NFL content on direct-to-consumer service. So that's going to be the app, and a deal with WWE. The reason that this one is interesting, I think, is that WWE is owned by TKO Holdings. TKO Holdings also owns the UFC. So technically separate businesses, but owned by the same company. So they are making a deal to have their premium live events, including WrestleMania, on ESPN and on the ESPN app starting next year. 5-year deal. Does this end up paving the way for the UFC to sign an extension of their deal with ESPN? And the way to think about this here, if you are TKO, is you want to reach the most customers and you want the most revenue. Those are the two things that you want. So if one of these big tech companies offers you a huge check, but they don't have a lot of users, let's say Apple TV in the MLS deal, they got a huge check from Apple TV, but there's not a lot of people that are watching MLS on Apple TV. So you need to have money coming in the door. ESPN is obviously spending a lot with the NFL and with TKO to get these WWE rights. Sounds like they don't want to spend as much on something like F1. Don't know what those negotiations are with UFC, but I think it's pretty clear that the users, the viewers that you're going to want to reach are going to be on ESPN. And the NFL becomes the draw. Do you want to be following the NFL's coattails? That's really what these other leagues are going to have to think about. If users are going to be subscribing to ESPN more than any other app for their sports, that's probably going to be where you want to be. So that's sort of the strategic backdrop. And with that in mind, let's go through some of the numbers. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. Because these were important, but not nearly as impressive. You can see overall for Disney, revenues were up 2% in the fiscal third quarter to $23.7 billion. Income before taxes increased 4%. Total operating income up 8%, and diluted earnings per share improved from $1.43 to $2.92. So things are moving in the right direction, just not very quickly. But if you dig down into some of the more important numbers, and I'll go by segment here because entertainment is kind of the driver of Disney. Is experiences is ultimately going to be where they make the most money right now, but experiences are really downstream from the studios and the TV networks. Linear TV obviously continuing to struggle, down 15%. This segment does not include ESPN. That's under sports right now. So, but this is going to be ABC, the Disney Channel, all those kinds of things. So that still continues to be in decline. But look at this, direct to consumer up 6%. And when you combine that with growth in content sales and licensing, the entire segment was actually up 1% in the quarter. So linear TV is dying, but this direct to consumer continues to drive the business. That's because people continue to sign up and pay their monthly fees for ESPN or for Disney Plus and for Hulu in particular. Now, the bullish thing with the NFL deal and the ESPN app coming out that I talked about earlier is that those three are now going to be bundled together. So the initial pricing is going to be $30 a month for the ESPN app, Disney Plus, and Hulu. Those are all going to be with ads. So the revenue for people who bundle with that is actually going to be pretty significantly more than that, more like $40, maybe even $50 per month, depending on how much viewership they get. But that's the advantage with having all these assets. You can bundle them together and essentially create a new cable bundle. If you look into the metrics behind the streaming business, not real impressive, but again, this is before the ESPN app goes over the top. So we'll see if these are improved at all by bundling up 1% on the number of subscribers to Disney Plus, and then Hulu up another 1%, 55.5 million. This is a really big business. I mean, Hulu generates $12 for just video on demand. That is significantly more than Disney Plus. Now, what management said is they're going to basically combine all these apps together, especially the Disney Plus and Hulu app. Even the Star business internationally is now going to become Hulu. So it's going to be a little bit more of a unified bundle that's a little bit more consistent, not only in the US, but around the world. Not quite so many logins, but it sounds like ESPN is going to be kind of sitting on its own. Speaking of the sports business, ESPN was actually up. So linear TV doing terrible, but ESPN still holds the power in the linear TV. Operating income was down 7%. I don't think there's a lot to be worried about there. They're investing in building out the ESPN app. So that's something that could pay off in the future. But these are going to be the numbers to watch as early as next quarter. Next quarter is only going to include about a month of the new ESPN streaming app and that new strategy that they're going to be launching, bundling those together. So don't expect huge numbers, but we are going to start to see, is the ESPN app going to have 24 million subscribers like ESPN Plus has, or is it going to be significantly more than that? The other big thing, parks and experiences. This is the profit driver for Disney right now. They just passed a $10 billion run rate in operating income. So $9.1 billion in revenue, most of that coming from domestic parks, added international and then consumer products. But that operating income number, this is what's really impressive. You're looking at Disney's stock, which currently has a market cap, $213 billion, total enterprise value of $250 billion. That's only 25 times just their parks operating income run rate. So you would get basically the content business in ESPN for free if you just look at it that way. So this is really the core. This is the foundation of these parks and experiences. Disney World, Disneyland, all their international locations, the cruise ships that they're building, those aren't going anywhere. So I think the upside is going to be in that streaming business that I talked about earlier. That's why the deal with ESPN and even WWE is so important. They need to attract subscribers to ESPN. That's got to be the foundation, the place to go for sports. And if that can become the best place to go for sports, attract the most subscribers, have them paying the most money or generating the most revenue with ads, that will be a massive win and will allow them to buy more sports rights in the future. This is how the flywheel gets going in streaming and in a lot of digital properties, is more users attracts better content, which attracts higher prices and more users, and on and on. That's how Disney wins with sports as the center of their streaming strategy. I think this is really starting to play out. I like what I'm seeing. Obviously, the market is seeing things differently right now, but I think 2026, we could see Disney generating more revenue from streaming than Netflix. Let me know what you think in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.